Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. And thanks very much for tuning in. Either you're going to see us or hear us. We're on YouTube, of course, Jeff Barton, the Mortgage Voice. If you go to the YouTube, click in as a guest and click in as a, request membership. We'd love to get you going, because when you do that, it helps other people find the show. And we're getting seen and heard by more people all the time. The information is timely, and it's really on a day-to-day basis. We do a daily show on LinkedIn as well as Facebook for about a minute, 2 minutes, just to give you a quick update. We're on 8 different podcasts, the major podcasts out there called the Big 8, and appreciate it if you do go there, click to join. We are always available if you go to YouTube, and certainly if you hear us on the radio in 5 stations, 3 states. We're excited about that. We're excited about the new opportunities that we have in Albuquerque, and certainly our newer, another new affiliate up in Las Vegas, Nevada, and our stalwarts in the Southern California area in the Inland Empire, and of course up in Tahoe. Thanks very much once again for seeing what we're doing. What's happening in the mortgage marketplace, what's happening in the real estate marketplace. These are the topics that we cover each and every week on the show, and this week is no exception. What we've seen from the real estate side, which is directly affected by what's happening on the mortgage side. The mortgage rates are what's driving the real estate demand. Because let's face it, even during COVID, we've had some issues with people who work, right? I mean, if you can't work, you can't prove your income, you can't get a loan. Well, it's held people back from listing their properties, and that in turn keeps prices artificially high. So all of this working together. The rates, let's talk about the rates, the Treasury and the Fed, keeping the rates artificially low. And I say artificial, what do I mean? Because market conditions don't dictate that, just like they don't dictate the true nature of how many people really want to sell their house or how many people really want to get out there and buy. So all things given what they are, given what they are, let's see what the rates are and why they're affecting markets the way I'm telling you they are. The rates today, another unbelievable week. This week. It is Taco Tuesday here at my house. So yes, it's first week of August, and we've got rates at 30-year fixed rates at 2.81%. That's 2.81% 30-year fixed. Think about that. 15-year, 2.38%. We're going to see rates in the ones. 1.8, 1.75. It's just, I get the feeling that this is going to happen. And why is it going to happen? And what are the needs of the market to make it happen? As I say, it's fueled by all this money, this infusion of cash, this purchase of mortgage-backed securities, and this purchase of treasuries by the Fed and the Treasury. All of this means that the markets don't have to worry about debt sold by the U.S. soaking up money that would otherwise go to the stock market. That's why it's an artificial number. That's why the stock market is very excited that the Fed and the Treasury is doing this. So what does this mean for you? You're the buyer out there. And by the way, FHA 2.25% and the jumbo at 3.65%. These are averages, of course. On lenders across the U.S., you might be able to do better, or depending on your credit score and some of the other things that make up what the loan is, you could do worse. But overall, these averages tell us that the market is stupendous and probably likely to stay there because, as Fed Chairman Powell said, we're going to do everything we have to do in order to keep rates near zero. These would be the open window rates that the member banks borrow from the U.S. government, which they, again, in turn, turn around and lend it out to you, the consumer, or to other mortgage bankers, which in turn lend it out to you. So it's this revolving amount of money. It's the freedom by which you have to walk into any bank or call any mortgage broker right now. And if you have a job, you have a pretty good chance of getting a loan at a historic rate that is really low. And we're still waiting for the real estate market to take that nosedive in terms of prices. I spoke today to a very well-respected stock portfolio manager in St. Louis, Missouri. Now, why I talk to these kind of professionals, because they have their eye on what is actually happening in the market, the stock market, meaning what are people doing with their money? Are they taking money out? Are they worried? Are they afraid? Are they reinvesting? And when talking about the real estate market itself and the fears of COVID and the fears of, the renters not being able to pay their rent, or the forbearance growing, although forbearance really has shrunk. I mean, it's below 4 million properties in forbearance now, when we were way up over 4.5 million. So those numbers have come down. And the reason for that is that there are several, but most of them are that people who want to take advantage of these rates can't be in forbearance. So it's best to pay your mortgage now, wait 3 months, continue to pay your mortgage, and then take advantage of the rates, especially if you purchase in the last 2.5 years. Obviously, your rate's going to be lowered, I mean, in some cases by 1.5, maybe even 2 points. So yes, it's really worth it to get out of forbearance and take advantage of that, because your long-term interests are really going to be in the best interest of your long-term interest is by lowering your interest rate. So getting out of forbearance, and that's why I think people have come out of forbearance. All of these factors, whether it be from Treasury, whether it be from the Fed and other government agencies, in order to prop up the liquidity in the market, is really to be taken advantage of. Now, they're in the real estate market. Obviously, sellers aren't selling as much as they were a year ago, and it's reflected in the numbers. Although what we've seen in new home purchases are really high, obviously, right? If you're going to buy a home and you have the choice to buy something that no one's ever lived in, so your feeling is, okay, I've got a brand new, clean home, and I think that's one of the issues here. Do I go into a situation whereby I have to deal with somebody else's home, and whatever that is in your mind, to what you're thinking of in a new home, which is like, no one's ever touched this, so I'm good. Now, whether that's fact or fiction, these fears play into the market. So the market itself is going to react to that by obviously building more homes. People want to buy new, and in some sections of the country, new homes are really cheap. If you go into Las Vegas, or you go into some other areas other than Southern California, Albuquerque, New Mexico is a good example. Down there, you can buy a brand new home for $250,000 or less. Las Vegas, Nevada, you could probably get from $275,000 to $325,000 or less. This is really a good situation for people who have a job. Obviously, the rates are low. And obviously, you taking advantage of what this situation is right now, because you have a job, you have long-term stability, they want to sell you the property, trust me. There are plenty of renters out there right now who are about to be evicted because that $600 a week allowance on unemployment extra that they were getting has ended. So what happens to the property owners of the people who are losing, renters? That's a problem. And when I asked this financial planner, this manager of high asset net worth people, what are you telling your people, when I'm pointing out to him that, we've got a real estate situation which is volatile. It's already propped up by the Fed. It's already propped up by the Treasury. And if you've got renters who are now not being able to pay their rent, well, that's one thing, renters on the street. But the other thing is the mortgages that need to be paid by those particular people who have investment properties. If they find themselves underwater, are they more likely to walk away, or are they more likely to try to figure out a way to pay the mortgage or get other renters in there who can pay? It's a dilemma, and it may cascade upon us in the next 2 to 3 months as we see more and more renters get evicted. So what is the solution to that, and how does it affect the marketplace? How can we maintain the status quo for a lot of these renters, obviously, and for the renters' landlords? And there's lots of them. A lot of people, and we've been recommending it for years, you might as well buy a home and get residual income and get the tax benefits. This is the strategy by which to build wealth in America through real estate. The answer is forthcoming, and hopefully the new coronavirus, bailout package from Congress, if it ever gets here, will be somewhat of the answer. I don't have the answers, but these are the problems facing us right now. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks very much for tuning in each and every week. We are on 5 different radio stations in 3 different states. I want to thank those people in Albuquerque, Las Vegas, the Inland Empire, and certainly up in Tahoe for listening each and every week. The Mortgage Voice can also be seen on YouTube. Jeff Barton, the Mortgage Voice. This, as well as over 200 other shows. During COVID, we also do a 1-minute mortgage minute every day on LinkedIn as well as Facebook. And certainly the Big 8 podcast, hear us each and every week. And if you go there, if you go to any of these places, sign up. The reason I say that is because the more people sign up, actually the more people get a chance to listen to what we have to say. And what we try to do for the show is to bring solutions to issues that come up every day, every week. And certainly during COVID, it has never stopped. It gets more complicated every day. And I'm not just talking the political side of it, the actual money. Can you get a loan? What's happening in the mortgage field? Anyway, to sort a lot of this through, we bring experts to the show. And Charles has been on the show many times. Charles Giscombe is a qualified employee mortgage manager for Malibu Funding in the state of Nevada, as well as does loans and all kinds of things all over the country. Charles, welcome back to the show. Thanks for doing it.
Yes, thanks for having me. Always a pleasure to be here.
Thanks very much. Quick question. In the place where you are, how are things and how are you dealing with the in-home situation working?
Well, you know what, Jeff? Fortunately enough for us, it is well here. I'm in upstate New York right now with the family, just making sure everything is good. Things have been loosening up, but I just always want to make sure that everything is secure and stable. So that's a blessing. And at the same time, working from home, we at Malibu Funding, Jeff provides an opportunity for individuals to be able to work fluently, comfortably from home. So we are able to provide all services and provide all information and consultation from where we are. So it is a blessing, and we're doing very well, Jeff, as Malibu Funding is doing well in helping individuals during this time.
You know, there is an article in the California Association of Realtor magazine, I'm going to get to it later in the show, that talks about the digital world being, what's here, what's now, and my take simply is we've been there for about a decade and a half in the mortgage industry, and we continue to improve those services for our borrowers. How is it affecting not being able to see face-to-face versus new way of doing business? Is it affecting how business is done for you?
Great question. Just being the individual that I am, and Jeff, you've obviously known me for many, many years. So, know, face-to-face is always my strongest suit. I mean, they do say I have a face for radio.
Come on.
I like to say when I get in front of individuals, it creates a level of comfort, and we're able to get down to business, people seeing us face-to-face. With that being said, though, Jeff, with the technology and what we've been able to do at Malibu and what you've been able to do and provide, it makes things a lot easier for us. Not only is it easier because, we have some things in place that allow individuals to fill out applications from a more digital standpoint, e-disclosures and e-signing and things of that nature, allow people to really fill out the information, get it signed, and get it back to us in a timely manner. And also allows us to transfer it directly into our LOSs, which are loan originating systems for individuals who don't know. That seamless transaction and transfer of information allows us to get things into the system in a timely manner and get people's loans submitted right away. So I do believe that I love face-to-face, but as far as the digital and the things that have been happening in the industry, it makes things a lot easier for us too as well. And the borrower, more importantly, for the borrowers.
Yeah, I think that's excellent point and also true. in the mortgage industry, and I think a lot of people want to see the face-to-face or want to see a big office with a bunch of people because they feel somehow more comfortable that, oh, look at all this huge support staff. But really in the mortgage industry, we've been dealing with at-home work for, like I say, over a decade. Even in the large institutions, a lot of the underwriters work from home. There's a lot more flexibility, and yet I think the productivity of our group, as well as the industry in general, is actually higher because we're more used to it. Can you tell borrowers how it works, or do they even ask? Especially now when everybody knows, oh, you're working from home.
Yes, you know what? It's so funny. They ask that. They're like, "How is it working from home?" And it's hard to answer that situation because Jeff, wherever we go, as I see Jeff oftentimes in Nevada, and I see Jeff in California, and different places that we go, we're all always working. Jeff's
Right.
always on his phone working. I'm always on our phone working. Wherever we are, we're always working. So I tell them all the time, it's easy. I'll be honest with you. Working at home has to do with the individual. We're in a business where we eat what we kill. And at the
Right.
end of the day, it's more important for us to get up with that discipline and wanting to provide a service and wanting to get out there and do loan work. I work perfectly from home because, I'm motivated to go get it. So I actually have more focus and have the ability to speak to individuals and actually help them with their concerns and have more time to walk them through from a more comfortable environment. So it allows us to have that one-on-one interaction that's necessary for people to create a comfort level for them, Jeff.
Okay, let's switch gears a little bit. You got a good program for somebody who's having some difficulty getting a conventional loan?
Absolutely. We always do. At Malibu, I always like to say, Jeff, problem solving on the fly is our
Right.
thing. And at the end of the day, more so than ever now, Jeff, individuals are having more difficulty because they're having a hard time showing
Right.
that they will be consistently employed, currently employed, and will continue to be employed. And so there's some things that people run into as far as getting verification of employment and things of that nature. With that being said, we always fall back into our non-QM situations. These are
Right.
loans that we consider non-agency situations that are not traditional and conventional. And they're more interested in what the borrower is actually bringing to the table, meaning what they're depositing into their accounts, whether they're self-employed, whether they're employed individuals who are taking a break. You still have the ability to show that you have the ATR, and that's mortgage lingo for ability to repay. A lot
Right.
of times, if you can show that you have the ability to repay, and it's been consistent over the last 2 years, a lot of these things will definitely, take precedence over a W-2 or paycheck stub or a letter of verification. And sometimes this is better structure for individuals than not. Sometimes this is the way that these individuals can go and show that they do have the ability to repay. So anytime a person can't qualify for a conventional loan or for FHA loan or anything that's considered traditional, there's always another route. We have loans, Jeff, that will take your bank statements. We have loans that will take a profit and loss statement. We have
Right.
loans that will allow you to close in your business name. Whatever your structure is, I like to say that we studied it all. We reviewed it all, and we're constantly learning every day on what other programs that are out there for individuals who don't feel like that they are traditionally structured for a traditional loan.
Yeah, I think that's exactly the strength, especially in the mortgage world where you're dealing with a lot of unknowns. You want to find a company that can look at you and find solutions for you individually. And that's really what the strength of mortgage brokering, mortgage banking is. Listen, Chuck, I'm up against the clock here. You want to shout out your phone number for people? I'm sure they want to talk to. Great.
I would love to, Jeff. I would love to. In Nevada, you can reach me at 702-328-5191. That's 702-328-5191. If you want to email me, I am Charles at MalibuFunding.biz. That's Charles at MalibuFunding.boy Isaac Zenith.
And that's a good call letter right there. Okay. Hey, Charles, thanks very much for coming on the show, and we'll talk to you real soon.
Hey, Jeff, I appreciate you being on. Thanks again, my friend.
Very well. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening each and every week. We're on the Big 8 podcast. So if you go there to any of these podcasts that are out there, make sure you go to The Mortgage Voice, Jeff Barton, The Mortgage Voice, and you can hear this show as well as archives of many hundreds of shows that have appeared. We do a daily 1 to 3 minute show on LinkedIn as well as on Facebook called The Mortgage Minute. So if you want to see us there, you certainly can. I'm Jeff Barton, and you can just request to let you into my circle, and you're in. Only you and 5,000-6,000 other people can do that. Also, we're on a radio circuit, about 5 stations in 3 different states, and of course YouTube, Jeff Barton, the Mortgage Voice. With us today again from Stearns Lending is Wendy Van Wessel, and I asked her to come today. Wendy, first of all, how are you?
I am fine. How about yourself, you and your family?
Thank you for asking. We're good. I mean, it's a day at a time. I think it's more mental than anything else, and people are just really tired of being, have to stay at home or not being allowed to go out or whatever it is that you want to do. So mentally, it's creating a lot of friction, I think, nationally as well as locally. But personally, we're doing fine. I mean, we live in a beautiful home and an easy community to live in, and we're 5 seconds from the beach. So how bad can it really be? Yeah, agreed, right? Okay. All right, I wanted to ask you a couple things. Stearns Lending, how are you guys faring, and what are some of the additional programs you might be offering people? I know last time you were on, you talked a little about some. I wanted to know if you had any new ones, and again, how you guys are doing through this.
It seems as though, since rates are so low, that the mortgage world is doing, thank goodness, knock on wood, quite well. The historic low rates, people who are still employed are able to get a better monthly payment, which is always helpful since everything seems to be going up, including groceries and all the other stuff out there. So we're doing very well as far as business goes. We have a lot of specials as far as programs goes. The government loans seem to be coming back. So our government purchases, the VA, the FHA, and the USDA rural, yes, they're out there and they're good loans. They're all a half a point better in pricing as the specials that we have now. We just finished a VA IRRRL, which is a VA streamline. If you have a VA loan and you know that we have historic low rates, you can get a streamline that doesn't need an appraisal and get your mortgage payments lowered as well. So the Govy side is back just a bit.
Hey, could you explain to me, now I know we throw this term out a lot, the USDA loan, what exactly is that? If you could explain it, because we have a lot of rural clients, or rural listeners rather, who do listen to the show from all kinds of places, whether it's down in Albuquerque, New Mexico, or certainly in Las Vegas, Nevada, or even up in Tahoe. Tell us a little bit about what that loan is and how one would qualify.
Well, they have automated underwriting systems for Fannie Mae, for Freddie Mac, and for USDA rural. USDA rural has something called GUS for their automated underwriting system. You have to have a certain amount of income. It used to be that you couldn't have an in-ground pool, but now I think you can again. But you have to qualify. You have to have a certain amount of income. You got to put in the address, make sure that you qualify that way, make sure that the address qualifies, and then have your broker go and run your address and make sure that it qualifies. It's a 1%. The rates are really low. They're a little bit more paperwork, but boy, is it a good loan when you can get it for those properties that are considered rural, and they can go over 40 acres. People that know how to do them, if your broker knows how to do them, there's great opportunities out there for loans for really good pricing.
Of those properties that do exist, and there's a lot of them, I would say more of America lives in that type of property than they do in the inner city in terms of apartments or condos. Qualifying for those loans, the 25-acre loans where you have a house on it, or some other rural property where there aren't a lot of comps, it's difficult for people, and a lot of times there aren't solutions. Was this type of loan affected by COVID and forbearances as much as, let's say, some other types of loans?
The forbearances haven't been on the rise. As a matter of fact, they've been on the decline. I think that a lot of
Right.
people didn't understand, well, I don't have to make payments. Great, because I don't know what my renters are going to do. So I think that the forbearances have been on the decline, like I said. And we also, if they did opt for the forbearances because banks were giving them away, if they didn't utilize it, they're still qualified for a loan. If they did utilize it and they have the funds to pay back what the payments that they missed, 2 or 3 or 4 by now, and they can prove it, they can do a loan right now. If they did a loan mod on the back end, making the terms longer or something else to make up for the missed payments, then they need to have prepayments that are on time. And every lender is a little bit different. We're at 3, which is a better
Right.
scenario than some other places out there that need 6 months of payments. But there's options for people out there, and the forbearances haven't ticked up as much as we thought. Even with the renters that don't have to pay their landlords for 12 months, they can negotiate the payments, which scared lenders a lot.
Well, yeah. I mean, I was talking to a financial advisor, somebody who was a manager in a big shop in the middle of the country, and asked him specifically about those things. I mean, what happens when, sure, the renters can't pay, they get evicted, but what happens to the landlord who's got to pay that mortgage, who all of a sudden looks at it, especially if we have a downturn or if we have some kind of a market upheaval because of the election, one way or the other? What happens to those lenders who've lent money to these people who bought these units to be able to rent out? They can't rent them out because the renters don't have any money because they don't have a job, and then they can't pay the mortgage and walk from the mortgage. What is the feeling in the marketplace when it comes to that kind of risk?
That is why lenders are cautious. If you look at them, they are giving you 75% of your departing residents. They're saying that if you don't have landlord experience, that you're going to have to do it at 50% unless you have 12
I
months
see.
proof of receipt. They're getting stricter on what kind of percentage and what you can do to offset your principal, interest, taxes, and insurance payment, your PITIA, right? So what can you do? What can you credit to the new borrower for those rental incomes? They're a lot more strict, so they have to have more insurance, more guarantee that they'll be able to make those payments is what they're looking at. Because if they have a forbearance on their books, they have to buy back that loan. If a person's unemployed, this is another one about that written DOE or verbal DOE right at docs. If they're not employed, then we don't have a sellable loan as a lender, so we can't keep doing that for millions and millions of dollars worth of loans. They got to make sure that they are employed. They got to make sure that they don't have the forbearance, and if they are in it and they pay it back, they have a stricter code on that rental income because they want to make sure that people have a little bit of play.
Okay, the information's great. It seems as if the strength of Stearns is large. Are you guys worried? Because I often ask lenders, okay, I understand where we are today. Everybody's in pretty good shape. Why? Because the rates are low. Everybody's refining. What happens, like I say, because nobody's got the crystal ball, how is risk mitigated and how are companies set up if, in fact, we have a worst case scenario or a bad case scenario with either the election or the virus gets extended or there's no vaccine or people don't get their jobs back because they've actually been eliminated? What is the plan at Stearns, and how are you guys set up for that, or do you even look at it that far down the line?
Oh, of course we do. And Blackstone, who now owns Stearns, looks at it too. First of all, we always like to say we have 3 pillars of strength. There were those non-QM loans that everybody was doing, those loans that were bank statements only and kind of like the stated program that we used to have of yesteryear. Those we weren't very heavily invested in those. The jumbo loans for the third-party originators, those also weren't really heavily investigated. We just had gotten one from like a Wells that was pricing really well, like the banks, but so well. And then we also have a lot of money to back us up from Blackstone. So we're not heavily invested in the QM, the jumbo loans. We have a lot of money backing us up. Those are 3 really strong pillars. We've been in business for 30 years, and that's what puts us in a really good position. That's Stearns. I don't know about the rest of them, but I know
of course,
to avoid forbearances and things like that, and making sure that they're employed. So that's where all of the verification comes in.
Thank you, Wendy. That's very good information. It shows the strength of what you're doing over there and why the company's been around for so long. People say 30 years, that's nothing. But in the mortgage business, we've probably seen 1,000 companies come and go in that 30 years, maybe more.
Yeah, there used to be something called the implodometer that you could look
Right.
at lenders.
It's still around. Wendy, thanks very
Oh, it
much for
is.
coming on. Yeah,
Well,
yeah, it's it's still around, but thanks very much for coming on the show. You want to shout out your phone number for anybody who needs some
sure.
information?
My name is Wendy Van Wessel. My number is 818-292-2572. If you have any questions, just let me know.
Wendy, thanks very much for coming on the show again.
Thank you, Jeff. Have a great day.
And you too. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening and tuning in each and every week. Our 5 stations in 3 different states. I want to say hey to all those people from Albuquerque up to Las Vegas, Nevada, into Napa Valley, as well as the Inland Empire, our stalwarts at KCAA and KMET. Thanks very much. We do appreciate it, and it does not go unnoticed. If you want to see the show, go to YouTube. Jeff Barton, The Mortgage Voice on YouTube. You'll see this as well as hundreds of other shows there. We do a 1-minute version of this show each and every day on Facebook as well as LinkedIn. And surprisingly, I've heard many people call me on the phone I haven't heard from in years saying they see me on the LinkedIn show on each and every day. So if you want to see that, just, hit me up and I'll approve you, or however it works to get you into my LinkedIn feed, and you'll be able to see that each and every day. We're on the Big 8 podcast. Really enjoy doing that. If you do listen on podcast or YouTube or any of these other ways that you can see or hear the show, make sure you join what we're doing, get involved. It helps other people find out what we're doing. And in the mortgage market and in the real estate market, especially today, things change fast, and they change for the better or for the worse. If you're more informed, you're more able to make decisions and change on the fly. And that's really why I invited our next guest to the show, Connie Hernandez from PMA. Been on the show many times, but I wanted to ask her to come back now. She has her hands all over what's happening in her particular area as well as nationally. Connie, how are you?
Fine, thank you, Joe, for having me on the show.
Thank you very much for coming on the show. Okay, first quick question. In the local market, in the area you are, I know you do real estate, and I know you do a lot of loans. How busy are you?
Oh my gosh, I am extremely busy. We are trying our very best to keep up with the demand, but yes, we are extremely busy, busier than I think I have ever been in the last 20 years.
Yep, I agree with that. And I think this time around, it's different than in 2004, 5, and 6, when even if you didn't know, you kind of knew something was wrong with the loans we were given. That's not the case today, is it?
No, not at all. The demand comes in with the really super attractive rates that are available in the industry, and more so for those people that obviously have taken care of their credit, have a good amount of equity. We know that a lot of people out there have a substantial equity. Their equity's grown as they purchased in the last 5-6 years.
Yeah, I agree with that. And now we had a guest on last week, Nina Penny, who talked a lot about reverse mortgages and how reverse mortgages, especially in a day whereby, maybe you need some cash in the bank, or maybe, your equity is such that you have over 50% in there, and maybe taking some of the money out is a good thing. Dealing with reverse or dealing with other cash out situations, what are you recommending to your clients today in regards to any of that?
Well, reverse is its own hour conversation, but I'll try.
Yes, I know. I'm getting the Reader's Digest version. Sorry.
So I'll give you my 2-minute version.
Okay.
If you are in a situation where a reverse mortgage makes sense for you, I highly recommend it.
Mm-hmm.
It's the best thing that can happen to someone in their years of retirement, where they want to actually enjoy their time and not be frustrated or stressed about making a mortgage payment. Of course, everybody's situation is unique, but by all means, I highly recommend reverses. I've been doing reverses now for many, many years, and I can tell you, I get a lot of thank yous from family members, from my clients. I get referrals. Truly, I don't market myself for reverses, but I do quite a few just on the referrals alone. And
Right.
that can only happen if it's worked for them. So that's my 2-minute version. So again, I highly recommend reverses if, again, it is the right loan for you. Now, as far as the cash out loans for all our other borrowers, it's a really good time to take advantage of the cash out if you have those really high interest rates on your credit cards or personal loans. And honestly, even some auto loans out there that are, I'll give you a good example. I did a cash out refi for a client, and $1,400 a month in payments going out. Her house payment was $1,200 a month. So high interest rates on all of her debt, a lot of debt because they had used credit to do some work around the house, emergency,
Right.
travel, what have you. They consolidated their debt, and they're paying a really low interest rate. My suggestion to them was, instead of, now you have $1,400 a month that you freed up, that you're paying debt on, take $500 a month of that and apply it to your principal. There's tons of formulas out there that you can look up and Google. You can talk to a financial consultant, to your loan officer, that'll guide you that if you are doing cash out and you are getting these really great rates and taking advantage of not paying those high interest rates, you can take some of that money now and pay down your principal and pay your home off in a reasonable amount of time.
Yeah, I think, anytime you can look to a situation, take advantage of it financially, if you can afford it, reducing principal certainly is going to reduce by tens and thousands, if not more, your mortgage over the long term, especially if it's a 30-year mortgage. No question.
Well, I've got a couple of really good stories. I even have a situation where we refinanced, paid off debt, and couple that was having a baby, and paying off their debt allowed her to stay home longer with the newborn, which was really nice to hear.
That's a big deal. I mean, yeah, that makes the mother feel good, and obviously with less stress that she has to go back to work, I guess. Yeah, that's a good thing.
It was a great thing. So again, everybody's situation is a little bit unique, a little different. If you get together with your loan officer, who is more than helpful to, able to help you kind of maneuver through all your questions and concerns, definitely is an amazing time to refinance. I mean, I've been in the industry quite some time, and I've never seen the rates this low.
Nope. I was saying the same thing. I looked at a rate for an FHA loan today at 2.25%. I'm like, okay, so even with your mortgage insurance that you tack on, it's going to be about 3.5%. That's amazing. I mean, and if you go DPA, down payment assistance program, you might be able to get that property for 0.5% and have a 3.5% loan with insurance. That's really stupendous. Exactly. It really is. Listen, I wanted to switch gears a little bit. Okay, Zillow, as we all know, has gotten into the real estate and mortgage business, right? And they're doing a lot based on the technology, based on the expectation of younger buyers, millennial buyers in the tech world, meaning that delivery of services, the expectation of the delivery in a way that's convenient and easy is really right up Zillow's alley. I know in our business, we've been doing it for about 10 or 15 years, exactly like that. Have you seen people take advantage of the delivery of that kind of information from you more so today than you did maybe, even a year ago?
Well, absolutely. And a big part of that is even some of my long-term clients, referral clients that were more apt to want to do a face-to-face meeting. We're doing a lot of Zoom meetings now where I'm getting a lot more applications on my website than I ever have before. And these are from, people that are, 50 plus.
Right. That's, yeah.
not
Right.
not our millennials. And I do on occasion get on the phone and help them navigate on how easy it is for them to log on to the website, fill out the application, upload their documents. It's
Right.
actually a much more secure way of providing us their information than
I like
being,
it much better. I agree with you. Yeah, I like the fact that you don't have to hand me a piece of paper that I've got to copy and then hand it back to you and then keep the copy. Forget all that. Just upload it. I mean, even the scanning from your phone, there are applications that you can go direct from that to any website and upload it. I mean, it's just makes the transaction easier, simpler, more safe. And I think in a large measure, this Zoom type experience is not as bad as I thought it was going to be.
I have to agree with you. Definitely agree with you. At first, it was a little bit of a panic mode, like I'm sure it was for
Yeah.
most people like us that were used
Mm-hmm.
to dealing with our clients face to face. Not so much for us, but for the sake of our clients, what they're used
Of
to.
course.
And I think now it's we thought this was going to be a 3 month, 4 months, 6 months. Now I don't know. We're going into possibly a year with
A year, right.
dealing with this. So I think that yes, by all means, we all have to look at the future. And you mentioned it yourself. Zillow was kind of leading in that direction, and I think
Right.
that's the direction most of us have to really consider jumping on the bandwagon and just following suit.
Hey, we're up against it. Could you shout out your phone number, let people know how they can get in touch with you, especially if they need a great loan officer?
Oh, thank you so much, Jeff. That's
You're
really
welcome.
kind. But sure, absolutely. I'm here to answer your questions, see if any assistance is at all possible. You can reach me at 626-422-2017 is my direct line. My office line is 626-918-2419. We're in downtown Covina, and we're happy to help.
Connie, thank you very much once again for being on the show and helping figure out what's going on now and what's going to happen next. Thank you very much.
Thank you, Jeff.
You're welcome. I'm Jeff Barton, your voice in the mortgage industry. That was Connie Hernandez from PMA, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for listening, and thank you for tuning in. We are on the Big Eight, and what are some of those Big Eight names there, Daryl?
Oh, we've got Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeart, Radio.com, and YouTube.
Excellent. And I also heard from Fred over at KCAA, one of our affiliates in the Inland Empire, that some of the podcasts were having some difficulties with content, with feed, with the ability to be able to provide the same level of content access to those people in those podcasts. We are not part of that group that the content has been questioned. We are a financial mortgage and real estate radio show that we bring to you each and every week. But just for people's edification, knowing that not only is Facebook and Twitter and Instagram and TikTok, but even, what we do here for podcasting, all of it is under heavy scrutinization by those companies that do not want hassle. They do not want controversy. They just want to see usage and people paying for advertising. That's all they really want. And if it comes down to the difference between getting rid of you and keeping their advertising base, you be gone. At our particular show, no, we appeal to many different demographics. And because the information is changing on a daily basis by what you need in terms of mortgage information and also real estate information, and that there's very little controversy in those numbers. I mean, you can talk about policy if you want. We can say, okay, why is Ben Carson's HUD not doing more to protect the COVID issues with forbearance when it comes to FHA loans? Sure, we can talk about that. But I don't have enough information in my head, nor do I think the audience is that really I don't think it's necessary for us to inform about the political machinations of what's going on in Washington. Suffice it to say is FHA rates are at lows that you probably aren't going to see. So if you want to, do a 3.5% down payment or less if you get a DPA, down payment assistance program, and you want to be able to get in on a rate that even with the private mortgage insurance is going to be less than 4%, which is truly unbelievable. Maybe 3.5%. I mean, we're quoting what is it? What's the rate here? I think it's 2.25% for FHA on a survey this week of the lenders. Truly amazing. So even 1.25% on a yearly, you're going to have a mortgage interest rate of 3.5%, which for FHA or for any loan is unbelievable. But for these market conditions are truly tremendous. Okay, ran across an article that I wanted to talk about a little bit today in the California Real Estate Magazine. These trade publications, and by the way, one of the topics I had today for the show and some of my guests, and I just want to read one question. Expectations in digital presentations, okay? So in the California Association of Realtor magazine, they talk about the transaction of the future is now, and they're talking about the digital transaction, but it's in a paper magazine. So it's kind of absurd that the actual answer to the question is done in old 18th century way of doing business. It's just blows my mind. Regardless, California Association of Realtors, like a lot of trade organizations, they collect a lot of money in dues. Part of what they have to do is spend that money in order to maintain their nonprofit status, and that's partly why this magazine exists. So when they talk about the transaction of the future, what are they talking about? They're talking about the things that we've adopted in the real estate profession for years, and in the mortgage profession probably for 10 to 15 years. It's the delivery of information via the digital format. The question of security, to me, is not as important as the speed and the accuracy by which you can do a one-on-one with whoever you need to talk to or speak to in the moment, in the now. The security that has been demonstrated with my company has never been tighter, has never been more secure. So that's why I say it's almost impossible to interrupt this stream. Now, where this problem exists is insiders handing out passwords. That's happened at Facebook, and it's happened at Twitter, and it's happened at a number of other companies. It's not somebody hacking in to my computer at my office. What's the good in that? Nobody's going to do that. They're looking for servers, server farms. They're looking for intersections of where the information gets passed from one system to another. That's where the breach is. And as the hackers get better, so does the encryption software, so does the ability by which to protect your information. So for me, this is something way above where I'm able to even follow, let alone comprehend. But I trust in the professionals that are out there doing the job for my particular company versus the job they're doing for the server company, for the, whoever's providing the information, wherever the pipes are going. All this is about security in that field. So therefore I say, okay, to me, it's not an issue for me to talk about. What is an issue is the convenience by which transactions take place. And they take place conveniently because there are things like DocuSign, DocuServe, iDocs, all different ways by which electronic signatures can be used in a legal fashion to secure real estate and to secure mortgages. They've even gone so far as I did a mortgage notary via Skype. Not Skype. We don't even use Skype. It was some kind of Zoom thing. It could have been WhatsApp, Zoom. There are a lot of these formats as well. The mobile notary came on and basically showed him my ID to the camera. It was great. I really didn't have to do anything. I just had to sign electronically and do the notarization via electronic means. So even that has been solved via the electronic signature, via the electronic medium, via, the online means. The question of whether my particular speed is up to par with what needs to be, or whether different areas of the country need to improve their speed, or if there's some way that my little town in Malibu, California is different than your little town in Hoboken, New Jersey. Whatever the demographics whatever the economies say that the speed has to be for that particular community, can it be that for that community? And these issues which were dealt with free access, and we've been talking about that in terms of, I guess, access to the internet and the speed by which you get your internet, or the ability to be able to charge different rates for different speeds. All of this has been dealt with over the last 4 or 5 years and continues to evolve. The question of access, the question of speed, but for the purposes of the future. Now let's talk of the future. Next year, 5 years, 10 years, whatever the future holds, this is going to be the medium by which most of these transactions take place. And if anything has shown us that there is savings, and it seems to be even more efficient to do it this way than to sit around a table, sign documents, and be done with it. Now, I know some states are not like that. I know many states back east are wet signature, what they call wet signature states, where you have to sign in front of an attorney. I know Georgia's a state like that, New York's a state like that, just to mention a couple. But anything west of the Mississippi, heck no. We're doing it with escrow companies and digital signatures and title companies and wires to be approved via digital means. I know in our own company, most of the wires that we send out internally. We do it all ourselves. We get charged for it. Now, maybe that is something to look into. But your transaction, you want to see a property? Go ahead. I just listed a property. Everything was done digitally. My showings are almost done digitally. You have a property you want to see, you go online. If there aren't 40, 50 pictures, you probably won't even take a look at it. The ease by which that end of the business is happening. So fewer properties are being seen until people are very sure they want to take a look at it, which is a good thing. Less traffic into the seller's place, less liability for the agent, less contact. Yeah, that's all good. So all of these things in the digital world are happening now. They're going to happen in the future even more so. And I think what the benefit is that you get a better transaction, not a worse transaction. You get more interaction. I mean, my face that you see on this show through YouTube on a weekly basis puts you way more in contact with what I'm thinking and feeling and how I am as a professional than you could ever get if we're sitting down having a cup of coffee. If we're doing that, yeah, you can get a feel for me in a different way, but in terms of a transaction and transactional work, this is actually the best way to go. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening once again. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.